Hello friends, this is Victor here. Welcome to the Intelligent Investor channel, where you will learn about stock investing analysis and personal finance that will help you become a millionaire investor. This past week, there was a huge sell-off of stocks across all sectors, especially the Nasdaq stocks in the US, because the 10-year Treasury yield suddenly jumped above 1.6%, indicating that there will be huge inflation risk that will affect all US businesses going forward. Many investors panicked and sold their stocks because they were afraid that their stock portfolios would drop further. In this video, I'm going to talk about the three major risks that may cause the US stock market to crash this year, and what are the best ways to prepare for a large market crash if the market drops as much as 30%, just like in March 2020. I will talk about these topics in this video. Major risk number 1, high inflation risk. Major risk number 2, high Shiller P ratio, aka CAPE ratio. Major risk number 3, overvalued growth stocks. And fourth, how to prepare for a stock market crash. If you like these videos, make sure to smash the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock investing analysis videos and personal finance videos that will help you become a millionaire investor. Let's start. The first major risk that may cause a large market correction this year is the higher inflation risk, indicated by the 10-year Treasury yield. Again, earlier this week, the 10-year US Treasury yield suddenly jumped to above 1.6% and now is at 1.407% at the time of making this video. Many investors are afraid that the US inflation rate will be much higher sooner than expected. Many investors decided to sell their stocks, especially the high-flying growth stocks, to have more cash on hand, or to move to value stocks, or to move their investments to other asset classes such as commodities that will be less impacted by higher inflation risk. Either way, a much higher inflation rate will be a huge major risk going forward that will affect all US businesses, especially when the US Fed starts increasing its rate and slowing asset purchase every month, which is known as quantitative easing. Because of the pandemic that started in 2020, the US Federal Reserve was forced to lower its Fed funds rate to a target rate between 0% and 0.25%. Obviously, lowering the Fed fund rates to near 0% is not enough to help the US economy recover from the current pandemic. So the US Federal Reserve is using quantitative easing to purchase 120 billion of assets each month, 80 billion of US treasuries, and 40 billion of mortgage-backed securities every month. Quantitative easing is essentially printing money in order to lower borrowing rates, to increase liquidity in the US economy, to encourage businesses to borrow more, and to encourage banks to lend more. This is the very important part you will want to know. Quantitative easing has caused the Fed's balance sheet to increase from 4.15 trillion in February 2020 to 7.59 trillion in February 2021 within a year. All these factors, including the sudden jump in the 10-year Treasury yield to above 1.6%, have caused many investors to fear that the US will have a much higher inflation rate later on, above the Fed's 2% target inflation rate on average over time. If you are an investor like me, it's important to keep track of the current 10-year Treasury yield, because the 10-year Treasury yield is the best indicator of investors' confidence about the US economy, US economic growth going forward, and anticipated inflation rate going forward. The 10-year Treasury yield also affects mortgage rates, corporate bond yields, and many longer-term borrowing rates. If the 10-year Treasury yield continues to increase much faster than anticipated, just like what we saw this week when it suddenly jumped above 1.6%, the US stock market will likely have more large sell-off this year. When the 10-year Treasury yield increases a lot, borrowing costs will be much higher for companies. This means companies with the most debt will be impacted the most. This is why most high-flying growth stocks also dropped a lot in the past 2 weeks. The second major risk is the higher Shiller P ratio, also known as the CAPE ratio. The Shiller P ratio shows that most US stocks were overvalued at the end of 2020. The Shiller P ratio is a much better way to look at the S&P 500 company's valuation than the regular P ratio. This is from Guru Focus. The Shiller P is a more reasonable market valuation indicator than the P ratio because it eliminates fluctuation of the ratio caused by the variation of profit margins during business cycles. The Shiller P ratio uses the S&P 500 company's average earnings per share adjusted for inflation over the past 10 years. In comparison, a regular P ratio uses the earnings per share of a company over the past 12 months. According to Guru Focus, as of February 28, 2021, the Shiller P is 35.4% higher than the recent 20-year average of 25.6. The Shiller P ratio's all-time historical average is 17.1. In the past 20 years, the only time the Shiller P ratio went below 17.1 was during the 2008 world financial crisis, when most stocks dropped 50% or more. If you look at March 1st, 2020, the Shiller P ratio was at 24.8. Most stocks dropped as much as 34% or more in March 2020, which means most stocks were substantially undervalued during this time. Personally, I think the current Shiller P ratio of 34.6 is high. This indicates that many stocks in the S&P 500 are overvalued right now. I believe a more reasonable Shiller P ratio is 30, which is halfway between 24.8 on March 1st, 2020 and the current 34.6 Shiller P ratio. If the S&P 500's Shiller P ratio is at 30, then most stocks in the S&P 500 should be more fairly valued. The third major risk is that many tech stocks, such as the high-flying growth stocks, are overvalued at the time of making this video. Whenever there's a large market correction, the high-flying growth stocks drop the most simply because they were already traded at a large premium before the market correction. In 2020, most tech stocks benefited a lot from the pandemic because everyone was working from home more, using online video conferencing, shopping online, playing more video games, streaming more videos, and buying more high-performance computers and devices. All these factors have allowed many high-growth tech companies to continue growing their revenues even during the pandemic. This is why most tech stocks performed exceptionally well in 2020. For example, in 2020, the Nasdaq index that focuses on tech stocks increased 43.6%, while the S&P 500 increased 16.26%. Here is another side of the story that has made most growth stocks overvalued. Since the pandemic started in 2020, there has been a huge influx of new investors, such as Robinhood investors, who started investing because they have to stay at home and work from home. Many new investors started day trading using their stimulus checks and their savings. Many investors wanted to earn the highest return possible by investing in high-growth tech stocks, penny stocks, IPO stocks, SPACs, and even meme stocks started by Wall Street bets. All the new money from the US government, the Federal Reserve, and new investors has caused most tech stocks to become overvalued. Just look at NIO and Tesla. They both performed exceptionally well in 2020. Even though I own shares in both Tesla and NIO and I like their businesses, I believe their stocks are overvalued at the time of making this video. When a large market correction happens, all the high-flying growth stocks would be impacted the most. Most investors would sell the high-risk growth stocks and move their investments to cash, value stocks, commodities, bonds, and other asset classes because they're afraid their stock portfolios would drop further. If inflation does increase much faster and higher than the long-term target 2% inflation rate, the US Federal Reserve will increase its Fed funds rate and lower its monthly quantitative easing program to lower the inflation rate. This means borrowing costs will be higher for businesses. High growth stocks tend to have more debts and less cash flows than value stocks. This also means high growth stocks will be impacted the most. Here's the important question: how to prepare for a stock market crash and how to take advantage of it. Personally, I've experienced both the 2008 world financial crisis and the most recent March 2020 market crash. I started investing in 2008 during the world financial crisis when the entire stock market crashed as much as 50%. In comparison, the stock market crashed around 30% in March 2020. The best ways to prepare for a stock market crash is to keep a lot of cash on hand, because you want to make sure your personal finance is not impacted if you see your stock portfolio drops as much as 30% or even 50%. You want to make sure you have enough cash to go through the entire market correction without selling your home or your car or your other personal assets. Another main reason is that you want to be greedy when others are fearful. The best time to invest in stocks is during a large market correction because the entire stock market drops as much as 30% or even more. This is because most stocks are greatly undervalued during a large market crash. For example, during the March 2020 market crash, most stocks were substantially undervalued, so I invested in Mercado Libre Meli stock, the Amazon of Latin America, using the cash I did not need. Now the stock has increased 250% in less than a year. This is just an example of being greedy when the market is full of fear. During a large market correction, most investors will panic and sell their stocks because they're afraid their stock portfolio will drop further. It's very easy to be fearful when the market crashes 30% or more, and it is very easy to be greedy when you see the stock market has increased 50%. But it's very important to not let your emotions control your reasoning, especially when the market crashes 30% or more, because the best time to buy is when there is a large market correction. Most investors cannot control their fears, their emotions. They buy when the stock market is full of greed, meaning most stocks are already expensive, and they sell when the stock market is full of fear, meaning most stocks are already much cheaper or even undervalued. Personally, I always do the opposite. I do not time the market. I always invest for the long term and wait for large corrections. I always look for the best test companies with the best long-term growth prospects and economic modes to invest for the long term. I always keep buying their shares whenever there is a large market correction, just like the large 30% correction in March 2020. Another best thing you can do is to always focus on generating cash and increasing your income through your job, your business, or anything you can think of. Why? It all goes back to being greedy when the entire stock market is full of fear. If you're a long-term fundamental investor like me, you want to invest in stocks when they are substantially undervalued. This is why it's important to keep finding ways to generate more cash by reducing your expenses and by increasing your income, especially during a large market correction. For example, instead of upgrading my 2014 BMW to a brand new Tesla Model S, I decided to hold off and save more cash now in case the market crashes more this year. I still keep my daytime business. I am not making any money from YouTube yet. I just want to create the best YouTube channel about investing and eventually reach over 1 million subscribers. In my daytime business, I am focusing on increasing my commission income by helping many more mortgage clients to buy their homes. Then I can reinvest the extra cash in the best US stocks for the long term, especially if the market crashes further this year. To summarize, I like to borrow Warren Buffett's famous quote: "Our goal is more modest. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful." If you like this video, smash the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock investing analysis videos and personal finance videos that will help you become a millionaire investor. This is Victor from the Intelligent Investor channel. Thank you for watching, and I will see you in my next video.